This is what we call the cash-on-cash return. Pretty simple. Cash-on-cash is a common investment measure showing the yield relationship between cash flow before taxes and the initial investment. So you would take your cash flow before taxes divided by the capital which you invested, and it spits out a figure which is your cash-on-cash return. Please note, you might use this with another combination, and I'll share that with you later. This might be your second filter. Cash-on-cash return. You think that's pretty important? If you get on a deal and your cash-on-cash return is 2%, you might say, you know what, for that I'll go to the bank and I'll take my chances with FDIC. Right? But if it's a 10% cash-on-cash return, would that be something that you might be interested in? I don't know. It all depends on how much money you want to make. And you will have a set criteria. But if you look at a deal and it's got a 12% or 10%, that might be something you want to look at further. If it's at 2%, are you going to waste your time? No. No. Again, is this something you can do fairly quickly? Yes, and I'll show you how. Okay? Now, there is one thing here that I want you to realize. We've already discovered how to get to the NOI, right? Some people call that cash flow. That's not cash flow. That's the net operating income. You have to take another piece to the equation that some of these people forget about. That piece is called debt service. So if you have a mortgage, now after the NOI, you have to deduct the mortgage payments annually to determine what your cash flow before taxes are. Okay? So we saw the figure, right? You get from NOI less, all right? What is it called?
Debt service.
Debt service. Okay, it's a little different than mortgage. So we have the DS, which is your debt service, and it equals what?
Cash.
What? Cash flow before what?
Taxes.
That's very important. This is the figure you would need to determine the cash-on-cash return.